Happy 2019. It's Jim Yent from Golden Years Advisors here to do our kickoff presentations. We're trying to do something different this year. We've broken the presentation into three separate pieces. The first, being this one that we're about to do, is our top 10 predictions for the market for 2019 based on the research of Bob Dole of Nuveen Investments. The second one is a deeper dive into the materials, and we're calling that our globalization presentation. And the third, because cybersecurity has become such an issue, we decided to focus specifically on that and have a session just devoted to that. So as always, we are Golden Years Advisors, Jim and Teresa Yent. We are investment advisor representatives who clear through our broker-dealer USA Financial Securities, and Golden Years Advisors is not affiliated with them. As you might have noticed, the setting's a little bit different where we're doing this video from. We're sitting in our Cozumel office, which those of y'all who've been long-term clients know we're in every January. You heard me jokingly refer to the Cozumel office. Well, this is it. Every January, Teresa and I get away. We go off-site so we can bury our heads deep into markets, economic research, and strategies and what we want to do on a game plan going forward. And this is where I sit every morning as Teresa's out scuba diving. I am at work, but this is my office. So I think you'll agree it's not a bad place to be if you got to have your head deep in thought. So this is the portion of the kickoffs that we've been doing, I think, for about 10 years now. We've loved Bob Dole. I don't know if you're familiar with him, but he used to be at BlackRock. He's currently at Nuveen. And for several decades now, he's always published what he calls his 10 predictions for the year. And why we like to show this to our clients is there's lots of people that make forecasts for the year, for each year. We at Golden Years don't like to be forecasters. We want instead to be adaptive and have strategies that are reacting and navigating the markets. But Bob is a forecaster, and Bob's one of the rare forecasters who not only publishes his forecast, but he grades himself over the course of the year and at the end of each year so we can see how accurate his forecasts are. So let's begin with a recap of last year, which was absolutely a year of contradictions. On one hand, we had some of the greatest growth worldwide economically that we had seen, yet markets across the globe sold off rather dramatically. In fact, only one country, Qatar, had a positive equity return last year. Other markets all in the negative. S&P down 4.5%, Russell 2000 down double digits, most of Europe down significantly more, China down 25%, yet growth, across the board growth. Very strange year. So let's talk about the highlights. As I said, the US expanded to our fastest growth rate since the Great Mortgage Meltdown. The rest of the world was growing, and it's the first time we've seen them all growing at once, but they did slow as the year went on because of trade concerns. As a result of the tax cut that occurred late in 2017, we had one of the biggest jumps in corporate profits that I've seen in the last decade. Astounding year-over-year growth, quarter by quarter. On the downside, I mentioned stocks sold off. In the US, not once, but twice, we had two corrections of 10% or more. And in fact, in the fourth quarter, as we all remember, from peak to trough, we fell not quite 20%. Volatility picked up dramatically in 2018. A lot of this was from a growing variety of fears, not the least of which was the US-China trade tensions, which was escalating all throughout the year with tariff versus tariff being levied on both sides, and a lot of policy confusion as to whether we're doing the right thing from a government perspective. So let's jump into Bob's predictions. Each year he gives it a name. He chose Charles Dickens' A Tale of Two Cities, in that there was two different ways of viewing the world, one half empty, one half full. And it proved to be very apt and accurate. His first prediction, U.S. real economy, real GDP, reaches the 3% mark, and nominal means real plus inflation growth exceeds 5% for the first time in over a decade. Bang, we did that. That's a really big deal, and we'll see how long we can sustain that. Second prediction, once again, dead on. Despite all the protectionism and the trade tariffs, the global expansion growth continued with the fewest countries in recession in history. In fact, As I mentioned a moment ago, for several of the quarters last year, no countries were in a recession, which I haven't seen in quite a while. Number three, unemployment did fall to its lowest level in nearly 50 years. Unemployment fell down to 3.7%, while wage growth, which has been stubborn to increase, and people have been saying that's why this can't last, wage growth has accelerated from 2.5% growth up to a little over 3% growth. Fourth prediction, correct. The yield curve would flatten, but not invert, even though lots of press was devoted to the fact that certain parts of the yield curve, specifically between the 2-year Treasury and the 5-year Treasury, inverted briefly. But most people think of the yield curve from the T-bill, the 3-month Treasury, to the 10-year Treasury. It did not invert, but 10-year Treasuries did rise, and they broke 3% for the first time since 2014. That was part of the reason why the market sell-off occurred late in the fourth quarter. His fifth prediction, once again correct. The U.S. stock market is now in its longest bull market in history. We did that on August 22nd last year. It surpassed even the golden 1990s expansion that many of us remember that ended with the tech bubble. But he also predicted there would be corrections, at least a 5% correction. And without a doubt, we had two 10%ers, so dead on again. Continuing on with the predictions, Bob thought that for the first time ever in 6 years, that the return of the markets would be less than the earnings growth. And boy, was it true. Earnings growth was a solid 20% growth, and we saw equity markets was clearly negative. So dead on that correction, on that prediction. Number 7, and this is a miss for him. He still thought that equities would beat bonds for the 7th straight year, and that would be a record for the past century. For 9 months of the year, this was absolutely correct, but that fourth quarter correction just wiped away all the gains of equities, and bonds basically came up to flat rather than negative, and clearly he missed this call. He had a split call on his 8th prediction. Corporate capital expenditures did increase a healthy 13% year over year, which bodes well for future growth for the economy because usually you get productivity gains from that. But he thought, and many politicians and pundits hoped, that the tax cut would mean greater expenditures and therefore greater future growth. We hope that's true. But they thought it would come with less share buybacks. And instead, we saw share buybacks spike over 60%. So he was right on expenditures, wrong on the buybacks. He thought that of the sectors, telecommunications, technology, and healthcare would outperform utilities, energies, and material. That was absolutely true on a full year basis. It was dominantly true for the first 3 quarters, but in that fourth quarter, utilities did get some lift, while energies, with oil prices falling dramatically and the dollar rising, material prices falling dramatically, was just a horrible performer. And finally, he always likes to make at least one political forecast, and I think it's just to make it easier. But, he predicted that the Republicans would lose the House, they would keep the Senate, and over time you'll watch more and more distance with Trump. I think it's fair to say that that was true. And what that really means going forward is not much is going to be accomplished in Washington for the next 2 years. We're going to watch a stalemate. So a simple tallying up of the score, Bob didn't do bad. 8.5 right, and out of 10, that's not something to be too embarrassed about. So let's turn the page and look at Bob's top 10 things that investors should look at for 2019. Well, to start with, it's still a very contradicted environment. On the plus side, economic and earnings growth continues to be strong, but they are slowing. So from a 3% growth rate of GDP, we should expect it to slow into the 2s, but still be above trend. And likewise, from a 20% earnings growth rate, we should see it decelerate into the teens and maybe even high single digits over the course of the year. Still a very positive factor for stocks. On the same side, the Federal Reserve, particularly in their most recent meeting, is signaling that they are going to slow the tightening pace in terms of actual rate hikes, and are even in the most recent meeting questioning whether they should change some of their quantitative tightening plans. So that should make for better financial conditions for both markets and the economy. Because of the sell-off that occurred in the fourth quarter, the market is no longer pricey or close to being expensive. It's very much near long-term averages. And as a result, there is a much more of an opportunity for upside from the current prices. And we've already seen that so far this year on the bounce back that has occurred. On the risk side, if there's one comment I can get across, it's just that there's more balls being juggled in the air. There's always a worry list of things that investors are concerned about, and it seems like the number of things that we're concerned about keeps growing. Not the least of which is still the trade issues. We hope that we have a positive resolution. Looks like we're moving towards one, but this has caused a great deal of uncertainty. Needless to say, the Washington shutdown created a lot of uncertainty, and uncertainty just translates into one simple thing: volatility in markets. So if we can get some of that uncertainty to resolve itself over the next quarter to 2 or 3, markets will respond well. Finally, one of the big issues is what is the right rate for interest rates and how fast is inflation going on? Because if it is accelerating, we know the Fed will raise rates to stop that inflation, and that will definitely end this market rally. So how did Bob describe or name this market? He called it a choppy and frustrating market, but saw no recession. One of the big concerns heading into the fourth quarter was with that slowing growth, whether we were edging into a recession, but he says no, which is the first prediction. Namely, the U.S. expansion continues. If we make it to June 30th of this year, it will be the longest economic expansion in history, even though our growth will be slowing from over 3% to somewhere in the 2–2.5% level. Secondly, unemployment continues to go lower. We're currently at 3.7%. Potentially it could go as low as 3.4, which would be a 65-year long record for the lowest we've seen. And wage growth on the plus side will continue to rise. I said earlier we're a little bit over 3%. We'll be approaching towards the 4% level as the year develops. The Treasury yield curve will flatten, and credit spreads between riskier bonds and safe bonds will widen. But that's a normal process late in an economic expansion. And we are late in an economic expansion. So for us, the yield curve inverting is a warning point of what lies ahead. So we're watching it and monitoring it. And as we'll discuss in our deeper dive presentation, we'll talk about some of the timings of that. Corporate earnings growth are going to be weaker this year. I just got off of an earnings call where fourth quarter is in the teens instead of in the 20s, earnings year-over-year growth. And the full year forecast going forward for 2019 and 2020, depending on who's providing the estimate, is somewhere between high single digits, like 9-ish%, to low teens. So somewhere in that 9 to 13 range, as both pressure because of rising wages gets on those profits going forward. From a U.S. equity perspective, Bob's predicting a positive return. Not too hard to predict since last year was a negative return. But he says something interesting in that he says he thinks we'll fail to reach record highs for the first time in over a decade. That's something to watch because basically, not at an S&P level, but the bounce back has already gotten most of the positive gains that many people had forecasted on a full year basis. So it just speaks to the choppiness that Bob is predicting. Bob's sixth prediction is that sometime this year, the dollar will sag. It's been rising for most of last year, and when it does, we'll watch a transition that U.S. stocks no longer outperform the rest of the world. for 3 straight years, both from a stock market, an economic perspective, from an earnings perspective. U.S. stocks have led the way, but that should flip sometime in the next 12 months, he predicts. From a sector perspective, he believes information technology, financial services, and healthcare will be clear outperformers over the more conservative utilities, REITs, and materials. His reason is simple. Technology is actually cheap. Technology and financials are actually cheap from a valuation perspective, and their earnings growth continues to strengthen. So it should be a pretty easy bet for them to outperform. From a federal budget perspective, we're getting close to $1 trillion deficit per year, which is hard to even imagine given that we've been expanding as an economy for 10 years now. But there's no politician in sight who's willing to talk about it. So we're probably not going to see too much more spending, just natural growth, but no one's really addressing the issue at hand. The only thing that possibly might happen is some kind of a modest infrastructure spending bill. From a political perspective, things are getting worse, without a doubt, in the U.S. as well as the U.S. Some of its Chinese negotiations are more than about trade. And so as this type of political uncertainty increases, markets undoubtedly will react over the course of the next 12 months. Finally, on the election front, we're already, the midterm elections are over, but we're already seeing candidates declare on the Democratic side, and he's predicting over 10 candidates, so it's going to be quite a field running on the Democrat side, and Trump will have challengers within his own party just because of the divisions within it. If you are a cable news junkie fan, stay tuned. You're going to have a lot of exciting moments. But from a market perspective, probably it's going to just stir up more than it's going to cause anything positive to happen. So it's a wrap. That's Bob Dole's 10 predictions for the market for 2019. 10 things that investors should be focused in on for the coming year. If you have any questions, as always, we're glad to field them. As you see on the disclosure screen, they suggest if you want detailed supporting information to go to the Nuveen website. Anyone who would like a copy of either our presentation or the report that this is based off of from Nuveen, we'd be glad to give it to you. Just give the office a call. And of course, we would love for you to schedule your time for your quarterly reviews so that we can address and apply the things that we talked about in this session to your specific needs in your portfolios and in your financial plan. This was our overview piece. For those of you who like more detail, there is a separate presentation that is coming out called our deeper dive, which we've entitled this particular session, Slowbalization, the fact that we're facing a slowing growth, slowing earnings situation, and what does that mean to markets. So if anyone who's interested, please stay tuned. That'll be made available probably in the next day or so. Thank you much and have a great day.